Not much of a reaction to the Bank of Japan hold decision, though it will be interesting to see if anything changes as the day progresses and the post-decision presser Q&A is digested, given a notable tweak in the statement removing guidance calling for inflation to reach its 2% target in fiscal year 2019. The market has been trying to figure out if the implication is as dovish as it might appear to be on the surface, with room for an alternative take. The BOJ could be moving in a different direction entirely with its policy guidance framework. Moving on, the dollar will be looking to see if it can close out the week with another impressive performance after building on momentum from the previous week. As things stand into Friday, the buck is up across the board since the weekly open, showing gains against CAD, the euro, yen, and Swiss franc between 1 and 1.5%, with Aussie hit just a little harder between 1.5 and 2%, and Kiwi taking it the worst, down about 2.3%. Diminished worry about U.S. protectionism and trade wars has allowed the market to shift its focus back to traditional global macro themes, with monetary policy normalizations and yield differentials coming back into the spotlight. The U.S. 10-year yield trading through 3% and the 2-year yield trading to its highest level since 2008 is a reflection of this fact, while the Kiwi underperformance provides additional confirmation, with the traditionally risk-correlated New Zealand dollar the most sensitive to this shift, with New Zealand having the highest interest rate amongst the developed countries. Earlier today, we got some disappointing trade data out of New Zealand, which hasn't done anything to help Kiwi's cause, while in Australia, hotter producer prices didn't do much to prop Aussie, though perhaps some of that demand from the producer prices was seen via the Aussie-Kiwi rate, which has been making a little recovery in recent days. Aussie-Kiwi is a market to watch in our view, with the rate starting to show signs of recovery after coming under intense pressure since the fall of 2017. Overall, it looks like this market is putting in a longer-term base off cyclical lows with greater risk for a significant move to the upside. While Kiwi has struggled mightily this week, the pound sits on the other side of the scale, with cable only down about 0.5% on the week into Friday. That's against the US dollar. The EU's chief Brexit negotiator was on the wires with some warning that financial markets should prepare for the worst and that the transition deal isn't guaranteed until the withdrawal agreement is officially ratified, though this hasn't done much just yet to hurt the pound. We believe the currency has held up well and should continue to outperform against its peers on the combination of a BOE that isn't too far behind the Fed with its normalization process and a UK economy that has held up historically well with a stronger currency at a time when the rest of the world is battling for the weakest currency, and risk markets could be exposed going forward as policy normalizations ramp up, making the more developed UK economy an attractive diversifier. Of course, we will see some short-term volatility in the UK today with GDP data out. Other important highlights on the calendar include German employment data, US GDP, and scattered central bank speak out of the ECB, SNB, and BOE, with Governor Carney headlining this docket. As a final note, in our technical overview, we highlight risks for a deeper setback in the euro over the coming days, with room for a decline towards 117, which would be a reasonable pullback, in our opinion, given this week's bearish price action exacerbated by an ECB decision that disappointed hawkish expectations. The euro weakness has pointed to an end to a consolidation that has gone on for the entire of 2018. We would also note that a pullback to 117 would be viewed as a short-term correction and would do nothing to compromise what has been the formation of a medium-term uptrend in the euro. That's all for now.